happy Monday, probably happy Tuesday when you see it, because once again I am late submitting my video to the Stockcharts team. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. I hope you all had a great holiday weekend. Maybe some of you took a holiday week with the 4th of July on Thursday, so Friday kind of a day off, markets were slow. Anyway, I hope you're all good, and let's take a look at what the markets have to tell us. And I had to, when I was preparing for this video, I was going over my charts and going over some RRGs and trying to come up with something new, because we've been talking about that weak breadth, that narrow foundation for quite some time already. So I didn't want to bore you again with that story, but I probably still have to. But I'll try to take it from another angle. And the reason is that it is still there. There is a narrow foundation. There is a small foundation. I just can't change the facts. If we start with the sectors, U.S. sectors. So here's the U.S. sector RRG. Last 3, 4, 5 weeks, story remains the same. We've got pretty much only one sector that is pushing into the leading quadrant at a strong heading, and that's technology. We have utilities inside leading, but on a long tail, rapidly losing relative momentum. It's still the highest reading on the RS ratio scale, so it is still positive. It's still a relative uptrend. And then we've got communication services, which is on the verge of crossing into the lagging quadrant. We got pretty much all these sectors here: healthcare, staples, materials. This is financials, industrials, energy, all on a negative heading. And then we've got two that are picking up, just moving into improving. That's real estate and consumer discretionary. And although they do have a strong RRG heading or a positive RRG heading, they are at the lowest RS ratio reading. And that makes them vulnerable for a rotation that completes on the left-hand side. I'm not going to say it's going to happen, but I'm not going to get overly enthusiastic for those two sectors either, because they are at very low readings. And if you just look at this RRG, then there's only one conclusion possible, and that is that the market is now carried and driven by technology stocks. There's just no other interpretation possible. And it's pretty much what everybody knows. So having said that, we've got to ask ourselves the question, is that a bad thing? It's probably not super positive, but if you look at the chart of the S&P 500, that doesn't hurt either. It's still going up, price trend's still there, and it's carried by a handful of stocks. So it has a narrow foundation, but that foundation seems to be strong, or at least it seems to be holding up so far. And as long as that situation holds, the stock market, like the broad market, the S&P 500, SPY, is still in good shape as a whole. But we need to figure out, and we will, whether that goes for all stocks. And the answer is no, that's for sure. That is the narrow breadth, that is the narrow foundation that we've been talking about. There are many measures of breadth, many ways to look at breadth, and I'll go over a few of them. So the one that I have in my chart list is the new 52-week highs. That's the number of stocks that made 52-week highs or new 52-week highs in the last week. And the way to read this chart, that's the top chart, by the way. So these green and red bars, columns are the new 52-week highs. If it's green, it's higher than last week. If it's red, it's lower than last week. And the blue line is the 13-week quarter, 13 weeks moving average of those new 52-week highs. And what you generally see is that during market rallies, that metric moves up. And when it starts to move down, it's kind of a prelude to a decline. If you look at most of these moves, you can see that here it starts to decline, and then you can see here that we rolled over. That's back in 2016. And pretty much every time when you roll over, you can see that the market is going through a setback, more or less. It's not a guarantee for a crash, but it's just like a sort of a warning signal that, hey, there are less stocks making new 52-week highs. That is a metric that usually bodes well when the market is in an uptrend. And when they stop doing that, that uptrend can still be there. Look here in 2021, it started to roll over somewhere in June, and it took for 6 months with a little hiccup here before the market really started to move lower. So it's a warning signal, and that situation is there, and it is there since, let's look at the peak of the moving average, somewhere in April, month of April, it started to roll over, and it's still there. Another breadth metric that I like to keep an eye on is the number of stocks that are trading above their, I'm going to say, N-day moving average. So the indexes below here, they are exclamation mark, GT, and then a number SPX. And that means the number of stock above, and then 200 is obviously the 200-day moving average, the 50 is the 50-day moving average, and the 20 is the 20-day moving average. So 20, 50, 200, short-term, medium-term, long-term trends. And if you look at the behavior of these metrics, you can see that they're all moving lower. All three of them have a moving average, a 13-week moving average, again, a quarter, 13 weeks, moving lower. And that is, again, that's not something that you like to see in an uptrend. In an uptrend, usually all those, number of stocks above a moving average is moving up, and it's corresponding, it's in sync with the S&P 500. Again, that's also not the case for at least the last 4 or 5 months. So all in all, again, it's nothing new. A lot of these breadth metrics are still narrow, and they continue to narrow. So they're narrowing. And it's something that keeps me alert. Caution is definitely there, because maybe, I don't know, maybe it's the wall of worry. Sounds too heavy. I don't want to make it too heavy. I'm not calling for a crash here, but if you just look at the characteristics of the market, if you look at the characteristics of the breadth and the foundation of the market, we just have to conclude and admit that it is very narrow. And a narrow breadth just means risky. That doesn't mean that it has to come down, but it's risky. And as a little side note, I want to tell you a story here that maybe you know, and if you didn't, you know now. We moved out of the center of Amsterdam to a farm about 45 minutes south of Amsterdam. It's an old farmhouse, and 3 weeks ago, or the idea was born a while ago. But for logistical reasons, we started 2 weeks ago. We said we're going to refurbish what is my office in the building here. And a long story, but we needed to do some remodeling. And we started to rip out plasterboard and floors and ceilings. And when we did that, we uncovered basically the bones of the building, the structure of the building. And what we found is that there are pretty serious constructural problems caused by, in the past, people ripping out a wall without getting back the proper support beams to, when you rip out a structural wall, you need to put in some sort of beam to support the ceiling on top of it. And that didn't happen. And the result is that we found a lot of cracks in the walls, like serious cracks, but also cracks in the foundation. So we had to dig out the foundation to see how serious it was. And it was serious, and we need to fix it, and we need to do a lot of stuff. But it reminded me of what we see in the market right now. When you peel off all those layers, when you look at that rotation, when you look at that market breadth, you're basically peeling off the layers of the market, and you find that the foundation of the market has a problem. And what I found out is that our house has a problem. It has a foundation problem. Does that mean that the house will collapse tomorrow? No, of course not. These remodelings or these, ripping out walls were done probably in the 70s, maybe the 80s. The house still stands. Some of the floors are not level. There's cracks in the wall. It's a little bit of, walls got not level anymore. But the house is still there. So the foundation is narrow, damaged, but it's still there, and it's strong enough to carry the building and to prevent it from collapsing. And again, back to the markets, the narrow foundation as we see it right now is still strong enough to keep the S&P where it is and even push it higher. So despite the narrow breadth, despite the narrow foundation, the market's still going higher, the market as a whole. Does that mean that the entire market is okay? No, because here also, not the entire house is okay. There's parts of the house that are not okay. And still the house stands. So what I'm trying to connect here is that even though you have cracks in your foundation, narrow breadth, your house does not necessarily have to fall over next week or tomorrow. And thus, despite a narrow foundation or narrow breadth, the market doesn't have to fall over tomorrow or next week. But what it does, or at least does to me, is that I'm worried about that foundation not being right. So we're going to put in new support beams. We're going to fix that foundation. We're going to make it strong again so that it'll carry the house for another 15, 20, 25 years or hopefully longer. And if you talk about the markets, the foundation of the market needs to be fixed. Does that mean that the market needs to collapse? No. Is it possible? Yes. And maybe the market can fix itself. Maybe there will more, like if you go back to these stocks above their moving average, maybe they will over time gradually, curl back up again, and we will see more stocks trading above their moving averages. Maybe we will see more new 52-week highs. And then the foundation of the market will have strengthened and it will have fixed itself. It will have put in new beams and more foundation, a better base for the market to rally. How that plays out in the S&P 500, I don't know. We'll have to wait and see. But as long as these cracks in the foundation are still there, I'm going to be very, very careful with the market as a whole. Probably the most important message that I can still give you this week. In my latest blog article of last week, I had a similar approach, looking at the major US stock market indices. And you can find that blog on the website. But what I found out is that, if these are only US based market indices. And the story here is that the smaller the index gets, so the NASDAQ 100, the S&P 100, and then the FANG, which is only 10 stocks. And here you got the NASDAQ Composite, that's 2,500 stocks, but it's predominantly technology stocks. And here is the New York FANG with only 10. So the further you go to the right, in general, the number of stocks in the index, i.e. the breadth, is getting narrower and they're getting stronger. So the New York FANG is the strongest of this entire group, and it has the least amount of stocks in it. So that's the point, again, pointing to narrow breadth, weak breadth. And if you dive into the members of the New York FANG index, then you will see that breadth gets even narrower, because even inside the New York FANG index, there's a bunch of stocks that are not doing well. Well, sorry about that. This is when you compare it to the New York FANG index itself. So they're all doing way better than the S&P 500, there's no doubt about it. But if you zoom in, you will find that there's only a handful of stocks, Nvidia, Apple, Tesla, Google maybe, Netflix, that are beating the New York FANG index, and the others are in relative downtrends. So narrower, 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 narrower. And for this video, I took the same approach, but now I'm doing it with international stock market indices. And what I did here is I've loaded up the RRG for international stock market indices. I added the NASDAQ and the New York FANG. And what you see is that, by the way, the benchmark here is the Dow Jones Global Index. It's world stock markets. And what you see here is that the majority of those markets are either inside the lagging quadrant and or at a negative heading. And the only ones that are doing relatively well, here's the blue one, that's the Kospi, that's South Korea. And then you got the Nifty 500 in India. And then the Hang Seng is inside leading, but it's rolling over. The strong markets are the S&P, the NASDAQ, and the New York FANG. This is obviously all US based and the major component in the Dow Jones Global Index. But the point is that even on an international level, on an index like the Dow Jones Global, the narrower indexes are outperforming. So even when you bring this to an international scale, it's only the US, and then in the US, only the FANG, the major large cap stocks, that are driving that market. Once again, a narrow breadth, and something to keep in the back of your mind, because when you look at the Dow Jones Global Index, that market is still going higher. There's no problem at all. The trend is still there. That house is still standing, but the foundation is narrow. And that means that it is risky. And investors don't like risky. Investors like certainty. And the certainty here in this market is only coming from technology stocks. And as long as that is the case, I will happily ride that move higher, but with very close stops, with probably not 100% allocation, definitely not 120, 130, whatever leveraged allocation, and monitoring it very, very well, because it is a risk on market, but with high risk. I'm going to leave it at this for this week. I hope you enjoyed it. Let's know in the comments what you think, how you feel about it, and we'll address that either with a counter comment or a reply to your comment, or we'll talk about it next week when I do a new video. Once again, thank you for watching, and I'll hope to see you again next week. Same time, same place.